And welcome back. So, right now, I'm going to look about the how to improve my financial literacy from Morningstar Investment Classroom, from the Asset Class and Downturns. So, over the last course or sections, such as the importance of staying invested and market downturns and recovery, and in that model, I look is the contraction and expansion phase, and also the downturns and recovery. So the main key takeaway of both topics is that by looking at historical data and see how the market performs, especially for long-term investors, is very helpful for those who wants to make long-term investment, such as retirement, and also to see that risk decrease over time. So, with the market contraction and expansion, which happens at random phases, especially the contraction phase, and that is the end of a market cycle, meaning a complete round in the price fluctuation. It's a complete round of a stock price fluctuation, and the definition of a contraction is when the stock market declined from its peak from 10% or more, and the expansion is the measure. Sorry. So the expansion is the measure of an index. The expansion is the expansion measures the recovery of an index from the bottom of the contraction from its previous peak and the subsequent performance until the next peak level before another 10% decline. So yeah, there is a lot of jargon here, and the core thing or the core topic of this is to define what is a market cycle, what is a recovery, which is a boom in the price security following a long decline. And the term is also to describe is the upswing in nation's activity economy. And the index, so which is an statistical reference of investment expressed as a percentage in for a period of time. So the whole idea of the index is to measure progress. So by looking at the contractions and the expansion phase over the last 49 years, from 1973 to 2021, and the market downturns and recovery, to see how historical data uh, for investors and makes a to see how the market performs by looking at historical data. And the U.S. equity market has crashed, or has passed through several downturns, and the most severe was at the start of the Great Depression in 1929. In this period, the recovery lasts for 12 years, and this when the stock lost over 80% of the value, 80.3, 83.4% specifically. Now, more recently, 44.7% uh, of stock loss uh, during the early 2000 dot-com bubble and the recovery lasting for 4 years in the 2007 2008 with the banking and debt crisis. The recovery period lasts for 3 years, so over 3 years. So when I saw this particular pattern, and again, by looking at the historical data and see this pattern, again, correlation, causality doesn't mean correlation, but in any case, can help you to make better decisions, and especially when you live in this economical system, because right now we are in this period, we're living in a recession, okay, that this recession might last a couple months or years. I don't know when, I don't know for how long, but if that is the pattern, so I can take more better, well-informed decision, and that's one of them. Looking at uh, all of those topics from the featured content, Morningstar, again. So from right now, I'm starting to making decisions that will impact my me from the future. So since I look at the past, or since I look at the market contraction and expansions and the downturns and recovery, then now I'm going to look is that, but orientate much more to a asset class, such as bonds, stocks, your portfolio. And this is the introduction of the asset class downturn. Okay, so this course looks at the downturns and recovery with respect to the asset class involved. So what you will learn is bond yield during recession, bond yield during recessions, stock returns and monetary policy, correlation in various asset classes with the market, the US market recovery after financial crisis with a balanced portfolio and with all stock portfolio. This course looks at downturns and recovery with respect to their asset class involved. We will look at stocks, bonds, and other class along with some sample portfolio structures. Okay. So this course looks at downturns and recovery with respect to their asset class involved. We will look at stocks, bonds, and other class along with some sample portfolio structures. We will also look at correlation of different assets with a broader market. Important. Okay. So this course looks at downturns and recovery with respect to the asset class involved, and we will look at stocks, bonds, and other class, along with some sample portfolio structure. Mhm. Okay, just to wrap up, okay, and to understand right now, perhaps by repeating is all of these topics, okay, to kind of guide us where we are heading. So in this course, we're going to look at the downturns and recovery with respect to asset class involved. So here I'm going to look at the bond yields What I'm doing here is just the same as I did when I started to look at the feature content. And again, staying investment section, that how to look at how they makes a case for staying put rather than selling your investment, and the table of content, the things I'm going to learn about, yes, the importance of staying invested, uh, um, period of consecutive negative returns, crisis and long-term performance, stock performance after the end of a recession, and the history of interest rate. So now I'm going to look is, well, bond yields during recession, and what I mean about yield is the returns. This is the UK term from that. Okay, so bond yields during recession, stock returns, and monetary policy. This to me is uh, this is a lot of jargon and terminology, specific terminology. You know, so bond yields and stock returns are the same, but this is the term used uh, for bonds, and the other are for stock. So bond yields during recession, stock returns, and monetary policy, correlation of various asset class with the market. Again, causality doesn't mean correlation. The U.S. market recovery after financial crisis with a balanced portfolio, and a market recovery after financial crisis, all stock portfolio. Okay, 5 topics: bond yields during recession, stock returns and monetary policy, correlation of various asset class with the market, the U.S. market recovery after financial crisis with a balanced portfolio, and the U.S. market recovery and financial crisis with all stock portfolio. Okay, so this course look at downturns and recoveries with respect to asset class involved. We will look at stocks, bonds, and other class along with some sample portfolio structures. So I'm not sure what is a portfolio right now. Generally, I don't know what is a portfolio. I just have an idea of what it might be. That, but yes. So we will look at stocks, bonds, and other classes along with some sample portfolio structure. And we will also look at correlation of different assets with the broader market. So okay, it all starts with bond yields during recession. So bond yields are driven by factors such as the supply and demand for loan. If I remember from, or if I recall good from the history of interest rates and how in that particular section from the importance of staying investment in the market, that the loanable fund, or like the stock market, the bond market is also affected by the state of the economy, and the bond market here, so or the bond yields are driven by factors such as supply and demand for loan, these loanable fund markets, when buyers and sellers or savers and borrowers uh, lend money to each other with interest rate reflecting loans of varying time and risk, okay, monetary policy, and inflation expectations. This is the core, especially if you're going to look for bonds. Okay, what are their measure? What are their driven factors? Okay, so bond yields are driven by factors such as supply and demand for loans, monetary policies. Okay, uh, it might be like the interest rate, monetary policy, or any other sort of monetary policy, and inflation expectations. So three factors. Okay, these government bonds are driven by factors such as supply and demand, monetary policy, and inflation expectation. Okay, so here I'm looking at this graph that I barely understand, but according to their legend, long-term government bonds, okay, where you have the interest, okay, started from 1946, and then they rise that until 1980s, okay. Okay, and short-term bonds with a more stochastic behavior, right? And shaded regions denote economic recessions. 1946, okay, economic recession. hmm During economic recession. So from this graph, what I can see is that during those economic recession from the 1980s, since the 1980s, the the demand for bonds decreased vastly. And again, government bonds are bond yields are driven by factors such as supply and demand, monetary policy, and inflation expectation. The Federal Reserve uses federal fund rates, which is the interest rate at which commercial banks lend fund each other overnight, and the discount rate, the interest rate charged for the interest rate charged from the Fed when lend short-term loans to commercial banks as it is primary tools to implement monetary policy. Okay. So when we talk about the monetary policy, the federal fund rates and the discount rates are so the Federal Reserve uses the federal fund rates and the discount rate as it is primary tools to implement monetary policy. Okay. Yeah. The federal fund rates and the discount rate. So during recession, the demand for loans falls naturally, and the Fed lower rates to reduce the cost of borrowing to help stimulate consumer spending. During expansion, the Fed may want to keep inflation in check and tighten monetary policy by increasing interest rates. And short-term interest rates like Treasury bill have a close correlation with the federal fund rates. Okay, okay. So short-term interest rates like Treasury bills have close correlation with the federal fund rate. Okay, so if you want to know what is the federal fund rate, the short-term interest rate like the Treasury bill have a close correlation. So if you want to know how is the interest rate at which commercial bank lend from each other, the treasury bill is a close correlation. It's a short-term interest rate correlation uh, rate. So which the Fed targets through open market operation. Short-term rate has been volatile, whereas long-term rate, which have a maturity of 20% or 30%, which have a maturity of 20 or 30 years, have been relatively stable and have taken longer to react to change in the economy. So yes, these short-term government bonds has been much more volatile. Mhm. Again, here is mainly the interest rate, but this is okay. How rates are affected by inflation. Bonds yield, especially long-term bond yields, are sensitive to inflation. Okay, so bond yield, especially long-term bond yields, are sensitive to inflation expectation because inflation can erode the value of the bond over time. If an inflation expectations are high, why an inflation can erode the value of a bond? In fact, what is a fucking bond? What is a bond? Investopedia. What is a bond? Mm, the term. A fixed income instrument that represents a loan made by an investor to a borrower. Is a loan made by an investor to a borrower. Okay, so a bond is is a loan by an investor to a borrower. Okay, I'm asking for this loan or bond. Okay. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought as an IOU between the lender and the borrower that include the detail of the loan and its payment. Okay, so on the loan it includes the details and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of the bond are debt holders or creditors of the user. Bond details include the end date when the principal, the original amount borrowed, or the original amount borrowed that remains unpaid in the case of a loan, when the principal of the loan is due to the pay is due to be paid to the bond owner, and usually include the terms for variable or fixed interest rates payments made by the borrower. So in other words, or a key takeaway, bonds are a unit of corporate debt issued by companies and securitized as tradable assets. A bond is referred to a fixed income instrument since bonds originally pay at fixed interest rates coupons to debt holders. Variable or floating interest rates are also now quite common. Variable or floating interest rates are also now quite common. Bonds price are inversely correlated with interest rates. When rates go up, bonds price fall and vice versa. Okay. Bonds price are inversely okay. So bond price are inversely correlated with interest rates. Mm, okay. Are are inversely correlated. Inversely correlated with interest rate. So when rates go up, bonds price fall and vice versa. Why? Is the interest rate when the rates go up, meaning if it costs more money to ask for a loan, those bonds price fall. Yeah, because it's like that you have to pay more. Now you have to pay more for those bonds. Bonds have maturity dates at which point the principal amount must be paid back in full or risk default. Okay, so what is a bond? Yeah.
Bonds are units of debt issued by companies or governments that are converted into tradable assets. Bonds are units of debt issued by companies or governments that are converted into tradable assets. Essentially, bonds are used to borrow money. For example, governments use bonds to borrow money to pay for schools, roads, and other infrastructure. War can also create a sudden need for funds. There are basically four primary categories of bonds sold in the markets: corporate bonds issued by companies, municipal bonds issued by states and municipalities, government bonds issued by the U.S. Treasury, and agency bonds issued by government-affiliated organizations such as Fannie Mae. For investors, bonds are thought of as fixed income instruments because they typically pay a fixed interest rate, or coupon rate, to bondholders, although bonds with variable interest rates are also common. Most bonds share common characteristics. The issue price is the price at which the bond issuer originally sells the bond. The face value is the amount the bond will be worth at maturity. The coupon rate is the percentage of interest the issuer will pay on the bond. The coupon date is the date on which the issuer will make interest payments. And the maturity date is when the bond matures and the issuer pays the bond's face value. The bond market also tends to move inversely with interest rates. So bonds will trade at a discount when interest rates rise and at a higher price when interest rates fall. In short, a bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments.
So, in short, a bond is not. Okay, a bond could be thought of as an IOU between the lender and the borrower that include the detail of the loan. Okay, and there are several things here to know. So who issue bonds? So bonds are debt instruments and represents loan made to the issuer. Governments at all levels and corporations commonly use bonds in order to borrow money. Governments need to fund roads, school, dams, and other infrastructure. They sudden expense of war. The sudden expense of war may also demand the need to raise funds. And that's how, for example, most empires have fun and strive to survive through war. So through war, so the issue is bonds. That's the excuse. Yeah, similarly, corporations will often borrow to grow their business. Okay, similarly, corporations will often borrow to grow their business, to buy property and equipment, to undertake profitable projects for research and development or to hire employees. The problem that large organizations run into is that they typically need far more money than the average bank can provide. Bonds provide solutions by allowing many individual investors to assume the role of the lender. Exactly. Indeed, public debt market let thousands of investors each lend a portion of the capital need. Moreover, markets allow lenders to sell their bonds to other investors or to buy bonds from other individuals long after the original issue organization raised capital. How bond works. Bonds are commonly referred to as fixed income securities and are one of the main asset classes that individual investors are usually familiar with, along with stocks, equity, and cash equivalents. When the company or other entity needs to raise money to financially projects, maintain ongoing operation, or refine existing debt, they might issue bonds directly to investors. The borrower issues a bond that includes the terms of loans, interest payment that will be made, and the time at which the loan funds bond principal must be paid back. The maturity date. The interest rate payment or the interest payment, the coupon, is part of the return that bondholders earn from loaning their funds to their issuers. The interest rate that determines the payment is called the coupon rate. Again, this is part of the anatomy of a bond. The initial price of most bonds is typically set at par at 1,000 face value per individual bond. The actual market price of a bond depends on a number of factors: the credit quality of the issuer, the length of the time until expiration, and the coupon rates compared to the general interest rate environment at the time. The face value of the bond is what will be paid back to the borrower once the bond matures. Most bonds can be sold by the initial bondholders to other investors after they have been issued. In other words, a bond investor does not have to hold a bond all the way through its maturity date. It is also common for bonds to be repurchased by the borrower if interest rates decline. And again, so if interest rates decline, meaning that the bond value increase, and that might happen during an economic contraction. Okay, that might happen during an economic contraction. Or if the borrower credit has improved and it can reissue new bonds at lower cost. Advantage and disadvantage of bond. Advantage: receive income through the interest payment. Hold the bond for maturity and get all your principal back. Hold the bond for maturity and get all your hold the bond to maturity and get all your principal back. Profit if you resell the bond at higher price. Exactly. Profit if you resell the bond at higher price. And how can that happen? During an economic contraction, when the interest rate fell and the bonds increase. Disadvantage: bonds pay out lower return than stocks. Company can default on your bond. Company can default on your bond. Companies can default on your bonds. Oh my god. bonds yield can fall. So, fast fact, many corporate and government bonds are publicly traded. Others are traded only over the counter or privately between the borrower and the lender. Characteristic or the anatomy of bonds: the face value, the coupon rate, the coupon dates, the maturity date, and the issue price. Okay, okay. And it all starts by asking, what is a bond? So a bond, the things to know from that is, a bond could be thought of as an IOU between the lender and the borrower, or the lender and the borrower, that include the detail of the loan. Okay, okay. So bond. Okay. So a bond could be thought as a bond could be thought as an IOU between the lender and the borrower, that include the detail of the loan. Okay, an IOU between the lender and the borrower that include all the details of a loan. That's what a bond could be thought of. That's what a bond could be thought of. Okay, okay, okay. So with that, all right, I'm going to wrap up this video until the next one. So, take care, bye bye.